Hey everyone, and welcome back to the Violet Vault. We talk a lot on this channel about investing in companies, but have you ever just stopped and wondered, who really runs the show over there? Well, behind the scenes, there's this incredible power struggle happening, and it has huge consequences for our investments and for the economy. So today, we're going to pull back that curtain and dive into the battle for corporate control. Right? I mean, who really pulls the strings? You see the flashy CEO on TV, you hear about the board of directors, maybe you think it's the brilliant founder who started it all. But what if I told you the real answer is a little more complicated and honestly a lot more interesting? The truth is, the real power often sits with a surprisingly small group of players you might not even know exist. And it all comes down to this idea of common owners. Now, stick with me here, because this is wild. Imagine one person owning a big slice of Coca-Cola and a big slice of Pepsi. Kind of weird, right? Well, now scale that idea way, way up. We're talking about a handful of massive investment firms that own huge pieces of pretty much every major company out there, even competitors. This gives them this incredible bird's eye view of entire industries and a level of influence that is just staggering.
Okay, so let's unmask these invisible owners. It's time to meet the true titans of the financial world, the institutional giants.
You've probably heard these names before: BlackRock, Vanguard, and State Street. Together, they're known as the Big Three. And listen, when I say big, I mean absolutely astronomical. We're talking about trillions of dollars under management. Trillions. They are, quite literally, the largest shareholders in almost every major company you can think of. So yeah, when the Big Three talk, you better believe CEOs listen.
All right, so how do they actually use all this power? I mean, what's their game plan? Let's open up their playbook and take a look at their strategy, what they prioritize, and how their sheer size changes the game. Okay, let's look at a real-world example with another giant, Blackstone. You remember the 2008 housing crash, right? Total chaos. Well, while everyone else was panicking, Blackstone saw an opportunity. They swooped in with about $10 billion and just started buying up single-family homes. Not a few, not 100, we're talking about 50,000 of them. They basically built a massive rental empire from scratch. That's a move only these giants can even think about making. Now, here's their side of the story, which is fascinating. Blackstone actually argues that what they did is a good thing for people. They claim that because they operate at such a massive scale, they can be super efficient. And they say it ends up being about 30% cheaper for someone to rent one of their homes than it would be to buy that same house in that neighborhood. Interesting perspective. But, and this is important, we gotta keep things in perspective. For all that money, for buying up all those houses, Blackstone owns, wait for it, 0.06% of all single-family homes in the United States. It's a tiny, tiny fraction. It's just a wild reminder of how incredibly huge the overall market is. Even for the biggest players on the planet, it's a vast ocean.
And their power isn't just about money. The Big Three are looking at the long game. They're using their influence as massive shareholders to push companies to change. They're demanding more openness about how companies treat their people, what they call human capital. They want to see real, concrete plans for dealing with climate change. And they're pushing for more diversity and better practices in the boardroom. Why? Well, they believe these things make companies stronger, less risky, and more profitable over the long haul.
But wait, it's not just the giants running the show completely unopposed. There's another player that's been stepping into the ring, and this one loves a good fight. Let's talk about the rise of the shareholder activist. So what exactly is the shareholder activist? Think of them as the ultimate backseat driver, but they actually own a piece of the car. They don't just buy a stock and hope it goes up. No, they buy a big chunk of a company specifically so they can get loud and demand change. They might want to fire the CEO, push for a totally new business plan, whatever they think will shake things up and get the stock price moving. And believe me, when I say they like a fight, I am not kidding. Just look at this ad from 2022. It literally says, "Beware, shareholder activism is showing its teeth." It looks like a movie poster for Jaws or something. It just perfectly captures how intense and public these battles can get. So what's in their toolbox? Well, first, they often target a company that's been struggling. Then they'll go to the media and publicly criticize big decisions or deals they don't like. And their biggest weapon is something called a proxy fight.
This is basically an election where they try to get their own hand-picked people voted onto the company's board of directors. And get this, a new rule from the SEC just made this way easier. Now every shareholder gets one ballot, a universal proxy card, where you can pick and choose directors from both the company's list and the activists list. It is a total game changer.
Okay, so we've got the giants, we've got the activists, but there's a third force that has completely changed the game in the last few years. And that force is you. It's all of us. It's the retail army. The scale of this is just wow. Over a single 18-month period recently, 22 million people started investing for the very first time. I mean, just take a second to think about that number. That's not a small trend. That is a seismic shift. It's a massive new army of investors, and every single one of them has a voice and, more importantly, a vote. And you better believe the big players have noticed. As this report puts it, the battle to win the vote of the retail investor, that's people like you and me, is now harder and more important than it has ever been. Your vote actually matters in these huge corporate fights.
And here's the crucial part. It used to be that if you didn't vote your shares, your broker could often just vote them for you, usually siding with whatever management wanted. Well, not anymore. Now, if you don't vote, your shares just don't get voted. This means companies and activists have to come directly to you and actually persuade you. You've become the unpredictable, powerful wild card in all of this.
So where is this big fight for control actually happening? Well, more and more, it's taking place on a new battleground centered around three little letters, ESG. That stands for environmental, social, and governance. It's basically the new arena for arguing about what makes a company good, everything from its carbon footprint to how it treats its employees.
For a while, ESG was kind of a total mess. People called it the ESG alphabet soup. I mean, look at this list. You had the CDP, the GRI, the SASB, all these different groups with their own set of rules. It was almost impossible for a regular investor to compare two companies and figure out who was really doing a good job. Thankfully, there's been a huge global push to clean all of this up. A new group, the International Sustainability Standards Board, or ISSB for short, is working to create one single, clear set of rules for everyone around the world to follow. Think of it as creating one common language for ESG, so we can all be on the same page. And this is a really, really big deal. Because as this quote points out, ESG is moving away from being just a feel-good PR move to being a required part of a company's official financial reporting. It's becoming data that's regulated by groups like the SEC, and when that happens, the stakes get way, way higher for everyone involved.
So let's bring it all home. What does the future of corporate control actually look like? Well, one thing's for sure, it's not going to be quiet. The old days of a few guys in a boardroom making all the decisions behind closed doors, yeah, those days are over. It is now a full-blown three-way tug of war for influence.
On one side, you have the established giants, the big three. In another corner, you've got the loud, aggressive activists trying to shake things up. And right in the middle, you have the massive, unpredictable, and powerful retail army, millions of investors just like you. So the real question is, who's going to win this fight? Who gets to write the rules for the future of business? I would love to know what you think. Drop me a comment below. Who do you think holds the most power in this new landscape? As always, thanks for watching. Don't forget to like and subscribe, and I'll see you in the next one.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's gonna make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
Hey everyone, and welcome back. Let's talk about a number that gets thrown around all the time on the news, something that sounds so huge it's almost not real, the US national debt. Now I know it's one of those topics that can make your eyes glaze over, but here's the thing, it has a very real impact on your money, your future, and yeah, the entire economy. So today, we're gonna pull back the curtain and figure out what this whole thing is really about. I promise, by the end of this, it's gonna make a whole lot more sense.
Okay, let's just take a moment and look at this number. Really let it sink in. We're talking about $30 trillion. That is a 3 followed by 13 zeros. To put that into perspective, if you spent $1 million every single day, it would take you over 82,000 years to spend it all. It's a number larger than the entire US economy's output in a year. And it breaks down to about $87,000 for every single person in the country. It is an absolutely mind-bending figure.
So what exactly is the national debt? This is a really important distinction because it's not the same thing as the annual deficit you hear about. Think of it like your own budget. A deficit is when you spend more money in 1 month than you earned. The national debt, though, is the grand total. It's like adding up all the credit card balances you've ever had over all the years, minus any years you paid it down. It's the country's total running tab.
And that, of course, brings up a really fascinating question. If the entire country is borrowing all this money, who on earth are we borrowing it from? Is it some other country? A secret cabal of international bankers? Well, you might be pretty surprised by the real answer.
So here's our game plan for today. We're going to find out who the real lender is. Then we'll take a quick trip through history to see how we even got here. After that, we'll dive into the big crisis versus calm debate. And finally, we'll look at the path forward. Sound good? Awesome. Let's get into it.
All right, first up, who's the real lender? Let's unpack who actually holds the IOUs on all this US debt.
Now, there's a really common misconception that the US owes most of its debt to foreign countries, like China. You hear it all the time. But that's just not the whole story. Not even close. In fact, a huge chunk of this debt is actually money the US government owes to its own people. Yup, to Americans, people like you and me.
Just take a look at this breakdown. It's pretty eye-opening, right? The biggest slices of this pie are actually domestic. We're talking US investors. That means your pension fund, your bank, even individuals who buy treasury bonds for their retirement. Then you have other government agencies like the Social Security Trust Fund, which invests its extra cash. The Federal Reserve holds a big piece too. Foreign countries are definitely on the list, but as you can see, they aren't the main event. This is what's known as a closed-loop system, and it's a wild concept to wrap your head around. Think of it like a big family. The parents, that's the government, borrow money from the kids' piggy banks, that's our savings and investments, to pay for a big household expense. In return, the kids get a super safe IOU that pays interest, and the family gets what it needs. It's this giant, interconnected web where the country's debt is also its citizens' financial asset. Okay, so now we know who owns the debt. The next logical question is, how did we get a number this big in the first place? Let's take a quick look back. This massive number didn't just appear overnight. It grew in these huge spurts, usually tied to critical moments in history. It really started way back in 1790, when the new US government took on the debts from the Revolutionary War. Then it spiked massively to fund World War II. It surged again after the 2008 financial crisis. And of course, it went into overdrive with all the emergency spending during the COVID-19 pandemic. And just look at World War II. To fund that war effort, the government had to spend on a scale nobody had ever seen before. The debt shot up to over 100% of the entire nation's economic output for the first time. It's a powerful reminder that in times of major crisis, debt has been the tool used to mobilize the country and get things done. Okay, that brings us right to the present day. And the great debate. With our debt levels back at those World War II era highs, is it time to panic? Should we be worried about this?
Well, there are two major schools of thought here, and both sides have some really valid points. On one side, you have the case for concern. These folks point out that the debt is as big as our entire economy, and they worry that rising interest payments will squeeze up money for other important things like education or infrastructure. Then on the other side, you have the case for calm. They argue that, hey, the markets aren't freaking out, borrowing costs are still very low, and there's huge global demand for US debt, which keeps things stable. It's a classic debate.
So what's the absolute worst case scenario? We're talking doomsday. It's something called a sovereign default. That's when a government just stops paying its bills. A default by the US would be absolutely catastrophic. It would shatter the government's reputation and could trigger a global economic meltdown. It would be like the bedrock of the entire financial world just turning to sand. It is the ultimate emergency button you hope is never, ever pressed. Which brings us to our final section. Okay, so what can actually be done? Let's talk about the path forward and the real-world options for managing all this debt. When you boil it all down, there are basically 4 big levers you can pull. 1, try to grow the economy faster than the debt. That makes the debt to GDP ratio smaller. 2, you can allow some controlled inflation, which slowly reduces the real value of what you owe. And then there are the 2 options that are always politically charged. You can raise taxes to bring more money in, or you can cut spending so you don't have to borrow as much. But this is where it gets really, really interesting. There's a huge paradox at the heart of this issue, and this quote captures it perfectly. What Professor Buchanan is saying is that trying to pay off the national debt completely might actually break the financial markets. And you might be asking, how is that even possible? Well, it's because that debt isn't just debt. It plays another crucial role. Let's break that down. US Treasury bonds, which are just pieces of the national debt,
are considered the safest investment on the planet. They are the ultimate safe haven for pension funds, banks, and other countries to park their cash. They are literally the grease in the wheels of the entire global economy. So trying to get rid of them entirely would be like trying to pull the foundation out of a skyscraper while you're still living on the top floor. And that leaves us with this huge final question. Is the national debt a ticking time bomb just waiting to go off? Or is it the very bedrock our entire global economy is built on? The honest truth is, it's probably a little bit of both. And figuring out how to balance those two realities is one of the biggest financial challenges of our time. So now I want to hear from you. After hearing all of this, where do you stand? Let me know down in the comments. Is this something that worries you, or do you think it's just a manageable part of our modern economy? Thanks so much for watching, and I'll see you in the next one.
Wow, that was something, right? But don't go anywhere, there's more coming, and it's going to make you think in a whole new way. Quick reminder, if you like learning cool stuff without the fluff, subscribe now. You won't regret it.
All right, let's talk about something that is driving so many of us absolutely crazy: trying to buy a house. You know that feeling, right? You're scrolling through listings, you find one you love, and then bam, it's gone. The competition is just brutal, prices keep climbing, and you're left with this feeling that the whole game is rigged. And the story we hear over and over is that Wall Street is the big villain, buying up every house in sight. But is that really what's going on? Is it that simple? Today, we are going to pull back the curtain and figure out what's really behind this housing crisis.
So, here's our game plan. We're going to start with that story everyone tells. Then, we're going to follow the money, separate the facts from the headlines. After that, we'll uncover 3 hidden forces that are the real power behind all this. We'll look at Wall Street's new playbook, because it has changed. And finally, we'll ask the big question: what does this all mean for the future of owning a home?
Okay, so you know the narrative. It's simple, it's easy to understand, and it's everywhere. These giant, faceless corporations with bottomless pits of cash are just swooping in, outbidding regular families, and turning the American dream into a rental empire. And let's be honest, it's a powerful story, because when you're out there trying to buy, it feels 100% real.
And this comment from Reddit it hits home, doesn't it? It perfectly captures that frustration. You do everything right, you find the house, you get your mortgage approved, only to get blown out of the water by an all-cash offer. There's just no way to compete with that. It's this incredibly personal and frankly infuriating thing to go through.
So all that frustration, it leads us to this one central question. Are these giant investment firms really buying up every single house on the market? Is this one villain the real reason you can't afford a home right now? Let's dig in and find out.
All right, to get to the truth, we have to do what we always do here. We gotta follow the money. We need to look at the actual data. It's time to separate what's fact from what's just a viral, angry headline and see who's really doing the buying and where they're doing it.
Okay, first things first, we need to clear up a huge point of confusion that's all over the internet. The name you probably hear the most is BlackRock, but here's the thing, they're an asset manager, and they've said publicly they don't buy individual houses. The actual player in this space is Blackstone, a private equity firm. I know, it's a small detail, but getting the names right is the first step to understanding what's really happening.
So, get ready for the first major surprise. According to the US government's own data, these big institutional investors own about 2% of single-family rental homes across the whole country. And you're probably thinking, 2%? No way, that sounds way, way too low. And you're not wrong to think that.
Because here's the catch. That 2% number is incredibly misleading. See, these firms don't sprinkle their money evenly across the country. They target specific cities. And when you zoom in on a hot market like Atlanta, that number explodes. In some areas, these companies own up to a quarter of all single-family rentals. So while they're not buying everything everywhere, in the places they choose to play, their presence is absolutely massive. This is why the story feels so true for people who live there.
But now, look at this chart. This might be the most important piece of the entire puzzle. It shows home prices have been climbing steadily since way back in 2012. That's long before this recent investor frenzy really kicked into high gear. And that tells us something critical. While these investors are absolutely pouring gasoline on the fire, they didn't start it. The fire was already burning.
So, if it's not just Wall Street starting the fire, what did? What are the real drivers? Well, it turns out there are these 3 massive, almost invisible forces that have been squeezing the housing market for years. They created the perfect storm that investors are now taking advantage of. Here they are. First, we have a colossal supply shortfall. For more than a decade, America has simply failed to build enough homes. It's a huge problem. Second, you've got something called the rate lock effect, which is basically freezing the market in place. And third, restrictive local zoning laws, the whole not in my backyard thing, are actively blocking new construction. These three things working together are the real root of this crisis.
Let's just zoom in on that rate lock effect for a second, because it is a monster. Put yourself in this situation. You bought your house a few years ago and you have an amazing 3% mortgage rate. Today, rates are closer to 7%. Why on earth would you sell your home, give up that incredible rate, just to buy a new one and have your monthly payment basically double? You wouldn't, and the data backs this up. For every single percentage point difference, the chance of a homeowner selling drops by nearly 20%. This is keeping millions of homes off the market, and it's crushing the available supply for everybody else.
Okay, so now that we get the underlying problem, not enough houses, let's circle back to Wall Street. Because they aren't the root cause, but they've gotten incredibly smart about how to play this broken game and profit from the chaos.
So look, this isn't just random house flipping anymore. It started after the 2008 crash, when they could buy up foreclosed homes for pennies on the dollar. But it's evolved. Now, it's this massive, sophisticated industry. They're vertically integrated, which is a fancy way of saying they control every single step, from buying the land, to building the house, to managing it as a rental. And they use powerful technology to pinpoint those exact markets where the housing supply is already being squeezed the tightest.
Let's get really specific and look at the playbook of a company like Invitation Homes. First, they aren't buying mansions. They target the classic American starter home, 3 beds, 2 baths. Why? Because that appeals to the biggest group of renters. Then they come in with all cash offers to win the bidding war. After that, they sink about 25 grand into renovations so they can justify charging a higher rent. And here's the kicker. After 2008, it got way harder for regular families to get a mortgage. But these giant firms, swimming in cash, they had no problem at all.
So you might be thinking, how can one company possibly manage tens of thousands of individual homes scattered all over the country? Well, the answer, like it is for so many things these days, is technology. In the olden days, being a landlord for properties all over the place was a logistical nightmare. But look at this chart. Venture capital funding for property management software has just exploded. This tech lets them run a huge national portfolio right from a laptop, at a scale that was totally impossible just a decade or so ago.
So here's the verdict. This is the big takeaway. These big investors, they are not the disease. They are a symptom of the disease. They looked out at the market, saw that it was broken by a decade of not building enough houses, frozen by the rate lock effect, and choked by zoning laws, and they built a brilliant, ruthless business model to exploit that weakness. They are an accelerant, making a really bad situation so much worse.
So with all that said, where does this leave us? Where does this leave you? How are all these powerful forces changing the future of homeownership and the very idea of the American dream?
Man, this quote right here just nails it. It really gets to the core of the whole issue. We are stuck in this fundamental conflict. Is a house a home? A place to put down roots, raise a family, build a life? Or is it just an asset? Another line item on a spreadsheet, designed to produce a return for shareholders?
And just when you think this can't get any more complicated, there's one last twist. While the supply of houses has been choked off, the demand for housing has been quietly growing for a completely different reason. Back in 1960, the average household had over 3 people. Today, it's down to 2.5. We have more people living alone, more smaller families, which means we need way more individual housing units just to keep up, even if our population didn't grow at all.
Okay, I know that was a ton of information, so let's boil it all down into the key takeaways. Number 1, there is no single villain here. 2, those big investors are a very real problem, but they're taking advantage of a crisis they didn't create. 3, the main cause is a decade-long failure to build enough homes. 4, the rate lock effect and bad zoning laws are squeezing the supply we do have. And finally, our changing demographics mean more and more people need a place to live. And all of this leaves us with one final, pretty unsettling question to chew on. As all these powerful forces keep pushing and pulling on the market, are we watching the end of an era? Is that classic American dream of owning your own home being replaced by a future where most of us are destined to be renters for life? It's a heavy thought. Let me know what you think in the comments below. I'd really love to hear your perspective on this. Is this the future we're headed for?
Thank you for spending time with us here at the Violet Vault. Don't forget to like, subscribe, and drop your thoughts in the comments below. I'd love to hear from you. Until next time, stay focused and keep growing.